There are two tax codes in this country. One is the one you file every April. The other one is the one your accountant never mentioned. And for most people, that silence costs them more money over a decade than any investment decision they'll ever make. This video is about the gap between those two codes. Not in theory, in numbers. I'm going to show you two guys who started the same business, the same year, worked equally hard for 10 years, and ended up $27 million apart at exit. The difference wasn't talent, it wasn't timing. It was a phone call one of them got in year one that the other one never received. Here's the thing about that gap. It doesn't start big. In year one, it's invisible. You'd look at both of their tax returns and shrug. But underneath the surface, one of them is running a structure that changes when tax triggers, how acquisitions get financed, and where passive income compounds. And each year, that structure doesn't just save money. It generates deployable capital the other guy doesn't have. Capital that buys assets. Assets that generate more capital. By year 10, you're not looking at a tax-saving story. You're looking at a completely different life. I'm going to show you 3 moments where their paths split. Each time I'll pause and show you exactly what's happening mechanically. Not the concept, the actual structure. By the end of this, you'll understand what a holding company actually does to the timing of your tax bill. How someone buys a $1.5 million business with $80,000 cash and a government program most people don't know exists, and why an offshore structure isn't about hiding money. It's about where interest compounds and when you choose to receive it. There's also a version of this that doesn't require a $1 million business to start. The same compounding logic applies at a much smaller scale, and I'll point to something near the end that runs on it. Alex filed his taxes the normal way. Marcus made a phone call. Let's start at the beginning. Alex filed his taxes in March. It took his accountant 4 hours. Marcus filed his in March too. But first, he had a 2-hour meeting that cost him $8,000 and changed the next decade of his life. Both of them started the same year. Same city, same service business, same $1 million in revenue. Alex's accountant was good, professional, efficient, got him every standard deduction available. Marcus's advisor did something different. He didn't file taxes. He drew a diagram. Here's what the diagram showed. When Alex earns profit, it lands in his personal account immediately. The IRS clock starts the moment the money arrives. He pays income tax, self-employment tax, the whole bill. Then he saves what's left. Marcus earns the same profit, but it lands in a holding company first. Inside that holding company, no personal tax is triggered yet. Marcus can reinvest it, use it to acquire, let it sit, deploy it however he wants. The clock doesn't start until he decides to extract the money to his personal account. In a form he chooses. At a time he chooses. That's it. That's the whole thing. It's not complicated. It's not exotic. It's a legal entity that delays when tax triggers. Alex pays tax first, then deploys what's left. Marcus deploys first, pays tax later. Same earnings. Completely different sequence. The advisor also set up an offshore structure for Marcus's savings. His investment returns would compound inside that entity, untaxed, until he chose to receive them. We'll come back to what that does over 9 years. The $8,000 setup fee almost killed the deal. Marcus sat in the parking lot afterward and called his friend. Is this actually real? The friend had sold his company 2 years earlier. You need my guy. 4 words. That's the whole information asymmetry. Alex had an accountant. Marcus had a tax strategist. Alex didn't know the second type existed. In year 1, that structure saved Marcus roughly $150,000 that Alex sent to the government. Not a lot on its own, but Marcus didn't spend it. There's a version of this that doesn't require a $1 million business to start. The same compounding logic applies at a much smaller scale. I'll come back to it. By year 3, Alex was at $1.33 million in revenue, growing clean. He heard about a competitor in his city whose owner wanted out. The business was doing $600,000 a year. The asking price was $1.5 million, a fair multiple. Alex ran the numbers. He'd need close to $1.5 million in cash, or a bank loan he wasn't confident he'd qualify for with his current debt load. He made a note in his phone. Revisit in 3 years. He moved on. Marcus heard about the same business the same week. He called his advisor. The advisor walked him through 3 numbers. $80,000 cash from Marcus, his 10% down payment. $300,000 from an SBA loan, a small business administration program the federal government runs specifically to help small business owners acquire existing businesses. Low interest, sometimes partially forgivable. The remaining $1.12 million structured as seller financing, meaning the seller agreed to receive the balance over time instead of all at once. Why would a seller agree to that? Because of IRC Section 453, the installment sale method. Under that provision, when a seller receives payments over time instead of a lump sum, they only recognize capital gains tax as each payment arrives. Spreading a $10 million gain over 7 years instead of taking it all in year 1 can drop them into a lower bracket on each piece. The seller wins. Marcus wins. The government program exists to encourage exactly this transaction. Nobody advertised it to Alex. Here's the part that compounds. The acquisition runs through Marcus's holding company. Loan repayments come from the holding company's pre-tax profits, not from Marcus's personal after-tax income. The business is effectively buying itself with money that hasn't been taxed yet. Every dollar of pre-tax profit used to repay the debt is a dollar that would have been reduced by 30% or more if Marcus had taken it personally first. Alex needed $1.5 million cash. Marcus needed $80,000 and a phone call to his advisor. The acquired business added roughly $400,000 a year in cash flow. Marcus now had 2 structured entities. The tax advantage compounded on a larger base, and his holding company had reserves Alex didn't have. That mattered 12 months later. Nobody predicted the price spike. It doesn't matter what caused it. What matters is that over 8 months, delivery costs across Marcus and Alex's industry roughly doubled. Both of their margins compressed from around 22% down to around 11%. Same squeeze, same timeline, same pain. Alex cut costs. He worked harder. He watched his savings rate slow to almost nothing. He was fine, but he had 0 slack. Then one of his direct competitors called him. A business doing $800,000 a year. The owners were underwater, exhausted, and willing to take $900,000 for something worth $1.6 million at a normal multiple. Alex did the math. He had to pass. Marcus got the same call. Here's where the offshore structure becomes concrete, and also where it gets more complicated than most people realize. Since year 1, Marcus's savings had been sitting inside an offshore entity. Here's what the advisor told him up front. If you own more than 50% of a foreign corporation as a US taxpayer, the IRS has rules called Subpart F and GILTI, Global Intangible Low-Taxed Income, that are specifically designed to prevent you from parking income offshore and calling it untaxed. Get this wrong, and you don't have a tax strategy. You have a compliance disaster. This is exactly why most people who try to DIY an offshore structure end up worse off than Alex. The structure only works when it's designed correctly from day 1, which is what Marcus's $8,000 meeting bought him. When it's done right, and the entity is structured around those rules rather than in spite of them, the returns can compound inside the vehicle far more efficiently than a standard savings account taxed as ordinary income every year. After 3 years, the difference wasn't enormous, but it was real, and it was liquid. More importantly, Marcus's holding company had reserves. The first acquisition was generating cash. That cash was sitting inside the holding company, and none of it had been extracted to personal income yet. The oil shock compressed his margins the same as Alex's. But Marcus was operating with a buffer Alex didn't have, built entirely from money Alex had already sent to the government. Marcus closed the distressed acquisition in 6 weeks. $900,000 for a $1.6 million business. The kind of deal that only becomes available when everyone else is too squeezed to move. Alex found out about the acquisition later. He wasn't bitter. He understood intellectually that Marcus had more capital. What he didn't understand was why. They'd started the same year with the same money. He assumed Marcus had just gotten luckier with clients. He hadn't. He'd just had a different meeting in year 1. By year 10, Alex had built something genuinely impressive. $2.59 million in annual revenue, compounded consistently from $1 million over a decade. He found a buyer at a 5 times multiple, $13 million gross. His accountant walked him through the capital gains calculation. He netted $8 million, more money than he had ever imagined having at 40 years old. He took his family somewhere warm and didn't check his banking app for a week. That's not a failure, that's a real outcome most people never reach. Marcus sold the same year. 3 entities structured through the holding company, exit routed through the offshore structure. The gross sale price was $42 million. Here's one number most people in that situation never think about until it's too late. Marcus's advisor had structured the operating businesses as C corporations from year 1. That meant Marcus's stock qualified under IRC Section 1202, the Qualified Small Business Stock Exclusion. On the first $10 million of capital gains from each qualifying entity, federal capital gains tax is 0, not reduced, 0. Alex sold an S-corp. S-corp don't qualify. That provision alone was worth over $2 million in saved taxes on Marcus's exit. Combined with how the remaining proceeds were routed through the holding company and offshore structure, Marcus's net was $35 million. He'd been building toward every piece of this since the diagram in year 1. They called each other around the same time that fall. Alex mentioned the exit. Marcus said congratulations. Neither of them mentioned the gap. What was there to say? Same city, same industry, same decade. Alex got a B+. Marcus played a different game. The gap wasn't genius. It wasn't connections or timing or luck. It was the diagram. It was the holding company that changed when the clock started. The seller financing that turned $80,000 into a $1.5 million acquisition. The offshore structure that kept compounding through an oil shock while Alex had nothing left to deploy. And then the exit, where the structure handled the final calculation the same way it had handled the first one 9 years earlier. Most people will hear all of this and think, I need a better accountant. That's wrong. Alex had a good accountant. What Marcus had was an advisor who designed a structure. Those are 2 different professionals offering 2 different services. Most people don't know to ask for the second one because the first one never mentions it. Here's what actually happened in that parking lot in year 1. Marcus's friend didn't give him the structure. He didn't explain the holding company or the offshore entity or the seller financing programs. He said 4 words, "You need my guy." And Marcus made an appointment. The information asymmetry between Alex and Marcus wasn't a conspiracy. The holding company is legal. The SBA acquisition programs are public. The offshore structures Marcus used are used by thousands of businesses. None of it was hidden in the sense that it doesn't exist in writing somewhere. It's hidden in the sense that you only find out it exists if someone who already knows shows you the door. Alex never met that person. What Marcus built over 10 years wasn't really a business story. It was a portfolio story. He wasn't optimizing revenue. He was building assets, each one structured to compound, to be leveraged, to serve as collateral for the next one, and ultimately to be sold. The holding company was the architecture. Everything else was a room inside it. By year 10, he had something you could exit, not just something you could sell. The same logic applies elsewhere. I've been applying it to a different kind of asset, one that doesn't require $1 million business or an $8,000 advisor to start. It's a model where you build a portfolio of income-generating assets using AI, and the same compounding structure applies at a fraction of the entry cost. If you want to see what that looks like, link is in the description. But here's the thing about the phone call Marcus got. You can make it yourself. You don't need a wealthy friend who sold his company. You need to know the second type of advisor exists and ask for them by name. A wealth structuring advisor, not a tax filer, a designer. When you call, say you want to understand holding company structures, offshore compounding vehicles, and acquisition financing programs. That sentence alone will tell you immediately whether you're talking to the right person. Alex filed his taxes every year, did everything right, and he built something worth $8 million, which is real and should not be dismissed. But the game Marcus was playing wasn't a harder version of the game Alex was playing. It was a different game entirely. Same board, different rulebook. One of those rulebooks was available to both of them from year 1. Most people will watch this video and file their taxes the same way they always have. A few won't.